The money that's going into gold traditionally is money that's coming out of equities. It's people that are nervous about equity markets. To have a supposedly safe haven asset in silver, that is also incredibly risky, incredibly volatile. I think you're going to see an awful lot of money that was in crypto and in NFTs and in AMC and all this ape money and all the stuff that's buying the double leveraged ETFs. Once they see silver moving, and you can make the case that by buying silver, I'm being more prudent, but look at the vol. I think you're going to see some truly extraordinary things happen in silver because the kind of money that's going to go into it is going to be the kind of money that just craves that risk and will chase it to who knows where.
Precious metals are entering a new strategic phase in global markets, with gold in particular signaling a shift in long-term investor sentiment. According to financial strategist Grant Williams, gold's climb toward $3,700 per ounce reflects more than inflation concerns or geopolitical stress. It represents a broader recognition of structural weaknesses in the global financial system. Williams argues that gold is no longer just a hedge, but a signal that central bank credibility, currency stability, and market fundamentals are under pressure. After decades of policy-driven asset inflation, many investors are beginning to question the sustainability of current economic models. This reassessment is driving institutional capital back to gold in a way not seen since the early 2000s. While gold has always held a central role in Eastern markets, particularly in nations like China and India, it has been significantly underrepresented in Western portfolios. Physical gold imports into the United States have risen sharply since late last year, suggesting increased institutional demand. Williams notes that recent purchases by high-profile institutions, including the Harvard Endowment, reflect a quiet but meaningful reallocation toward hard assets. Yet despite record prices, retail participation remains limited, a factor he believes could lead to a second wave of demand once broader awareness sets in. According to Williams, the market is only beginning to price in the long-term effects of monetary debasement and the erosion of purchasing power. Silver, often viewed as gold's more volatile counterpart, may be poised for an even more dynamic trajectory. Williams suggests that silver will attract a different kind of investor, those with higher risk tolerance and an appetite for speculative upside. With the rise of crypto markets and meme stock mania in recent years, younger investors have grown comfortable with volatility and are increasingly seeking assets that offer asymmetrical returns. Silver, with its dual role as both industrial commodity and monetary asset, fits that profile. Williams expects the introduction of leveraged silver ETFs to act as a catalyst for a surge in speculative flows. While such a trend could produce rapid price appreciation, he cautions that it may also mark the final phase of the current financial cycle. Now, we present the clips from Williams' interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, I think silver's going to be really interesting this time around because previously when silver has had its moment in the sun, it's generally followed gold, and it's more speculative. We understand that the industrial uses of it waver over time. They vary over time, and the end of silver as an industrial metal has been called more times than I can imagine, but that's simply not the case. But what's going to be interesting this time is when money starts to move into silver. The money that moves into gold is generally speaking cautious money. Yes, there is some speculative froth in gold. Yes, there are people who see the momentum it has and are trading the momentum. I get that. But generally speaking, when money moves into silver, you've had this extraordinary explosion of appetite for risk because of the way central banks have managed markets, managed interest rates to provide that safety net every time markets look like they're going to fall. People are much more comfortable taking risk. And in fact, because of the advent of crypto and NFTs and all the kind of highly, highly speculative stuff, you have an entire generation of investors who crave the most risky thing they can possibly find. And we can talk about it being this idea of financial nihilism where they don't believe unless they get the 100 bagger that they're ever going to get the ability to buy a house or start a family, or all those things, which, I understand those feelings. But the money that's going into gold traditionally is money that's coming out of equities. It's people that are nervous about equity markets. To have a supposedly safe haven asset in silver, that is also incredibly risky, incredibly volatile. I think you're going to see an awful lot of money that was in crypto and in NFTs and in AMC and all this ape money and all the stuff that's buying the double leveraged ETFs. Once they see silver moving, uh, and you can make the case that by buying silver, I'm being more prudent, but look at the vol. I think you're going to see some truly extraordinary things happen in silver because the kind of money that's going to go into it is going to be the kind of money that just craves that risk and will chase it to who knows where. That sounds strange with gold nudging $3,700, when a lot of people were talking in not too distant memory about it wouldn't get through 2000, or once it did, it was going back to 1300. We're nudging 4000 now, and it's got there very quickly, and it's certainly garnered some attention from people who weren't paying attention before. At the end of the day, gold's a curious thing because there are long periods of time where nobody really needs to own gold. You don't need to own it. It's never a bad thing to own, but there are periods of time when everything's calm, when you can invest your capital in more risky places with a lot more comfort than you can right now, perhaps. And so between 1999, let's call it, and 2005, nobody needed any gold. Between 1980, when inflation peaked, and 1999, nobody needed any gold, and the price reflected that. It went from 800 to 250 odd dollars. Nobody wanted to own it. But since the turn of the century, and since it became pretty clear that the path forward for just about every central bank in the world was going to be currency debasement, gold is something that it has made an awful lot of sense to own. Now, that hasn't meant a lot of people have owned it because at the same time, stocks and shares are going up, and that's what was in the news, and that's what was on CNBC, and that's what their friends were talking about when they were telling them to buy Cisco and Intel and all these cool shares that were going up. Your bond portfolio did well, real estate was doing well, everything was doing well, and so no one really needed to focus on gold except the people who either perhaps spent more time looking at monetary systems in general, spent more time perhaps studying Austrian economics, spent more time understanding the reason that things were going up was not necessarily because everything was great and business was booming and the markets were representing economic reality, but the fact that what they were really representing was this currency debasement. And you can see it in share prices, you can see it in asset prices, and it's being reflected in gold. But everybody understands buying houses, everybody understands buying shares, everybody understands buying bond funds. Buying gold is just that little bit of extra work. It's a little bit more complicated. And when you don't need to complicate things, people don't do it. And so that's why in the West particularly, there's a massive underowning of gold right now, I think. And that's why you're starting to see the price move as it is, because people are trying to play catch up. It's different in the West, in the East, as you well know. Gold is much more of a way of life there. It's much more of a familiar asset to own. And so we're in that period now where investors in the West are looking at what's happening. The penny's starting to drop, and they realize that gold is, if not the solution to this, then certainly one of the primary solutions to this. And people are starting to adjust accordingly. And I personally think that the fun and games in gold, and particularly silver, is really just getting started because people are still trading it. Once we get to the phase where people realize that they have to own it, things change dramatically because when people want to own it, it's not for sale. And that could lead to some real interesting moves.
The dominance of the US dollar as the world's primary reserve currency, a status it has held for decades, is now facing unprecedented challenges that could reshape the global financial system. This shift accelerated significantly after the U.S. government's decision in 2022 to freeze Russian central bank assets following Russia's invasion of Ukraine. According to Grant Williams, This action sent a powerful signal to every central bank around the world that holding large dollar reserves carries political risks, as sovereign assets can potentially be frozen or impaired by foreign governments. In response, many countries have been actively seeking ways to reduce their reliance on the dollar to protect their economic sovereignty. This includes increased purchases of gold as a secure store of value, efforts to trade in their own or alternative currencies, and forming new trade agreements that bypass the dollar. While the dollar still remains the backbone of global trade and finance, driven by concerns over geopolitical tensions and the desire for greater control over national reserves. Simultaneously, the rise of digital currencies and stablecoins is ushering in a new era in global finance, one that comes with both opportunity and risk. Legislative moves, such as the passage of acts enabling the widespread use of stablecoins by financial institutions, are setting the stage for a digital financial infrastructure that could enhance efficiency but also increase government oversight and surveillance. Grant Williams highlights that, as digital IDs and transaction tracking become more integrated, there is growing concern about privacy and the potential for intrusive monitoring of individuals' financial activities. This development may be more readily accepted by younger generations who prioritize convenience and digital access over privacy, while older generations remain wary of losing financial autonomy. In this uncertain landscape, precious metals like gold continue to serve as a critical hedge against not only economic instability, but also against the encroachment of digital surveillance.
This is a fascinating discussion, and there's a lot of people focused on it, but the best analogy I can think of is when you've got termites eating your house. Your house looks great, and you swear to God it's in great shape, and it's the best looking house in the neighborhood, and then one day the whole thing falls apart because that one termite takes that one bite out of the wood that weakens it to a point of collapse, and it collapses. And I think when we look at the dollar as a reserve currency, the termites are eating away at it. Now, it doesn't mean it's going to collapse imminently like that metaphorical house. It doesn't mean it's going to go away as a major trade currency, but the incentives have changed. The incentives have changed since Russia invaded Ukraine, and I've talked about this a lot. That the week that they froze those Russian central bank assets back in 2022, I wrote a piece called "The End of the Financial World as We Know It," and my point then was the very fact the United States did that and froze another central bank's sovereign assets completely realigned all the incentives for every central bank in the world. And I mean every single one, because obviously with the dollar being the world's reserve currency and the world's energy currency, there isn't a central bank in the world that doesn't own dollar reserves, because they either have to import energy, in which case they need dollars to pay for it, or export energy, in which case they receive dollars for it. So everybody owns some degree of dollar reserves. And you have, at a stroke of a pen, told every single one of those central banks that there are circumstances which we can't define under which we will impair your sovereign assets. And we've just proven what they are. And in Russia's case, it's because they crossed the Ukraine border. We can't guarantee you what those circumstances are for your particular country, but you can no longer assume with 100% certainty that there is no chance we will ever do that. And as soon as you do that, again, incentives change, and every single one of those central banks now, as a matter of national security, has to have a plan B so that there is no way that their sovereign assets, their sovereign currency reserves can be impaired by another government. And from that day to this, we have seen that taking place. Those of us who watch the gold market have seen it taking place in plain sight. The amount of buying of gold by central banks has gone through the roof, and with good reason. We can see the fact that other countries are trying to divest themselves of reliance upon the dollar. It doesn't mean they're going to stop using the dollar. It means at the margin, as and where they can, they will reduce their dependency on it. For some, that is selling treasury bonds and buying gold. For others, it's trying to arrange trade deals in their own currency or the currencies of their trade partners without going through the dollar. There are all kinds of ways of doing it. It's undeniable that that's happening. It's also undeniable that so far it hasn't made a difference, except at the margin. But it's also undeniable that every house that collapses from termites, until it collapses, looks fine from the outside. So I think this process is underway. It's not going to happen imminently. And that's not to say there isn't some way the United States can, regain the good faith and the trust of the world. It's not a 0% chance, but it's going to be very, very difficult. And in the meantime, until they find a way to actively gain that trust back, and that's not an easy thing to do in these circumstances, until they do that, until the day they do that, everybody is looking at how we can diversify away from the dollars, how we can be less reliant on the dollar, how we can be less vulnerable to United States policy. So it's happening. It just hasn't shown up yet. It hasn't made a material difference yet. But the numbers tell a different story that bit by bit, piece by piece, people are moving away from the dollar.
Or little by little. That's right. Exactly.
Or little by little. There you go. Yeah. I should have given you the plug, shouldn't I?
Yeah. Well, and that speaks to logarithmic decay, little by little by little, then bang. And I see so many things. We'll save that for another discussion. But so many things happening with the BRICS that are largely being ignored by the mainstream, and even by folks in this industry that are ignoring what's happening very quietly. Some really substantial things that are happening. So we'll save that for our next conversation.
The response has generally been, as each BRICS summit comes and goes, people say, well, they didn't announce a BRICS currency, so clearly it's a load of old rubbish. But as you say, there are little agreements being made here. There are rails being put in place, payment rails being put in place. There are swaps being put in place. All this stuff is happening. And whilst it doesn't give you a really easy headline that says, okay, I need to do something now because look at what that headline says, things have changed. If you're paying attention, all of these little things that get agreed and signed and handshakes and photo opportunities, the one thing they have in common is they're moving in that direction away from the dollar, and people need to understand that.
The evolving landscape of international finance is poised to enhance the significance of precious metals as key instruments for safeguarding wealth and managing risk amid mounting uncertainties. With growing doubts surrounding the stability of conventional fiat currencies and the increasing geopolitical fragmentation prompting nations to seek alternatives, unlike digital or paper-based financial instruments, these metals provide a tangible store of value that is not subject to the same vulnerabilities of inflation, currency debasement, or political interference. The demand for such reliable assets is set to rise substantially. This trend not only reflects a strategic move to hedge against systemic financial shocks, but also signals a broader recognition of the enduring role that these metals play in preserving purchasing power and ensuring liquidity. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.